Let's take a brief look at what we'll be covering this week. As usual, number one is the same every week, rates and yields. We'll look at real yields and option-adjusted spreads tied to specific assets. Move on to a review of the jobs report we had last week, and we'll look at the economic calendar for the week coming up. Last week, I talked about MicroStrategy now trading at a discount to Bitcoin. That discount got even deeper, so we'll revisit this MicroStrategy story. NVDA, lots of talk about NVDA causing the problems last week in the market, and it wasn't. It was Bitcoin. We'll do an earnings debrief, and we'll see that most of the stories that were floating out there in the narrative about NVIDIA, oh, you got to be concerned with its inventory build. Oh, you got to be concerned with the receivables. Oh, did you see the share count increase? None of that is true. Then we'll move on to SPY, look at the earnings calendar for the week, and we'll spend most of our time with Circle and understanding stablecoin. If I can get you at this moment to grab your mouse and slide it over to the like button, click on that. It'll give me a thumbs up on that one, which is good for the YouTube algorithm. And then while you're there, slide it on over to subscribe and click on that. We do plan on covering one company a week in new or emerging sectors. Next week's a bit of a treat. We're going to look at data center connectivity. What connects these things? I'm going to highlight two companies in that space. All right, let's head in. Okay, let's have a look at our week. We had a good week in duration. We had rates all pulling back a little bit. We have higher probability for a rate cut in December. It's looking like more probable than not. And look at our capital market yields, all of them down. And I will say this week made a lot of sense. If you gave me these and you said, okay, well, let's have a look at the banking index, what would you say? I would say, well, we have an increased probability of rate cuts and the capital market dropping. That should have been positive for the banking system. There is KRE up 1.13% while the market was down. KRE up. Also, look at the 2-year to the 10-year. It is up 3 basis points, a little bit of steepening, but taking it away with the 3-month 10-year, so sort of a neutral there, but just the expectation of rate cuts and a lowering of the capital market curve, positive for KRE. Dollar had a good week, 0.9, still down for the year, but dollar strength coming back, maybe. This lowering of the long end of the curve is positive for bond-like equities, like REITs, IYR up 0.2. And typically when you have this sort of thing going on, equities down, defensive sectors do well. There's XLP, which has been negative for the year because the equity markets have been on fire, pulling out almost a 1% increase, while SPY was down almost 2%. 275 basis points of outperformance from XLP this week, acting as it should. Very defensive. Look at these drops. SPY 1.92, IWM holding up. Look at that. Down, but only 0.79% against SPY and Triple Q. Oh my God, get me out of the AI trade, which is overdone, by the way. That is not a bubble. I'll talk about more about that later. Down 3%. And TLT up 0.71, still under $90. Still disappointing me after another long year of dating. I think I'm going to break up with TLT soon, unless it does something for me. My forecast still remains the same for December 2026. The information over the last week has not changed anything. I do think our effective federal funds rate will drop to 2 to 2.25 by the end of next year. The 10-year in the range of 3 to 3.5. The 10-year, that would put the slope, the 2-year to 10-year, 75 to 100 basis points. We're sitting at 55 now. And the 3-month to 10-year, 100 to 125 basis points. We're sitting at 16. All of this, great for banks. So I give you the yield curve on January 1st. Here we are on November 21st. And this is what I'm projecting for 12 to 18 months out. Let's look at ZQ. Thank you, ZQ, for finally showing up, for finally showing some rationality, for finally saying, hey, you know what? Maybe we should price out a Trump-led Fed differently than a Powell-led Fed, and maybe the curve should be steeper after we get past May. Here it is right here. Maybe we should have sort of a steeper curve, and it's trying to do that as much as it can. Q4, we now have pricing in 19 basis points. Q1, 18. Q2, a full rate cut there, 25. Q3, 25. So once you get past June, notice that your rate cut seemed to be 1.25, but before there it's like, well, maybe, I don't know, not quite committing to it, but leaning in that direction. April is 2.905 ZQ at 97.095. Implying 97.5 basis points, or 4 cuts in 11 meetings, 7 of them without Powell. So while the market was down, I'd explained this before, my big position in ZQ allows me to take a lot more risk in equities than I normally would. And all week long, even though the markets were down, I was still up. By the end of the week, I was up because ZQ really saved me. We're going to get those rate cuts. If you're looking for that left tail hedge, I don't know that you need to look for it in options. I think you can find it in ZQ. Looking at real yields, they are all down. Looking at our break-evens, inflation expectation in the form of a break-even, all of them down as well, and corporate spreads up. What is going on this week? Everything seems to be rational. This is what you would expect. Now, we do have lower real yields, which is supportive of precious metals, but you had a much stronger US dollar than you had a drop in real yields. Blind me and ask me where gold is. I would say, well, it should be lower week over week. My God, it is. So is silver by a bit more. The industrials were down this week. Aluminum was down. We can see down here oil was down, and silver has a significantly large enough industrial component that it was dragged down with that. So not only the stronger US dollar, but a little less confidence on the industrial metals. Wheat and corn, look at the drop in price year to date, almost 15% and 14%. Soybean up. Heading down to mortgage-backed securities, up 0.09. This is the ETF that holds mortgage-backed securities. Agency and Annaly, which are, you can call them active funds per se, the management companies. Agency giving back, Annaly moving forward. Mortgage rates up a little bit, 6.26, waiting for that elusive 5 handle. Will we have it by the end of the year? If we get another rate cut, where are we on that? 71%, up from 44%. What a difference a week makes. 71%. We get that in 17 days. Can we all wait? It's like Christmas, right? What are we getting? We're going to get something. What, when we open that box, lump of coal or 25 basis points. Plus, we get a new summary of economic projections. So down here, this is the Fed governor projections for 2026. Pricing in 50 basis points. We get a new one in 17 days, so this will change. Are we going to get something different than 3.38? I would seem to think we should. But I seem to think if we get a 25 basis point cut, and this is 75 basis points, there's your 100 basis points over the next year at a minimum. And at a minimum, ZQ pays me. So my downside of ZQ is either I make good money or I make a killing. Let's see if I get 200 basis points. Heading out to January, no cut, 20%. That means nothing in December, nothing in January. It was 34% probability of that, down to 20. At least between these two meetings, one cut is now 58%, up from 48%, and 50, a cut and a cut, 22%, up from 16%. Reverse repos, 2.5 billion. Was under 1 billion on November 18th. That's the lowest. Hit 905 million. Repos, 1 million. In terms of billions, at 0.001. Almost non-existent. 1 million is nothing. Reserves, look at this. We're up at 2.91. Why? The TGA is down at 9. TGA down about 50 billion, reserves up. This is the argument I've been making for reserves. We don't have a liquidity crisis brewing. We had reserves that were building up in the TGA. These are not reserves. Well, they got to pay people now, so the TGA will go down and reserves will go up. Let's have a look at the jobs report we got last week. Rear view mirror jobs report, but everything's still falling in line with what we thought. Also, BLS will not publish an October 2025 employment situation news release. Establishment survey data for October will be published with the November 2025 data. That's the establishment household survey data were not collected. And I sort of agree with them on this. You can't go back and collect that. But the establishment data, well, they have records. So they could just say, well, we'll look back in our records and we can fill this in. Were not collected for the rest of the period due to lapse in appropriations and will not be collected retroactively for both surveys. The collection period for November 2025 data will be extended. An extra processing time will be needed. The employment situation news release for November is scheduled to be published on Tuesday, December 16th at 8:30. Not in time for the Fed. The Fed will be blind on this one. So we did get some data, but look at this. Revisions, July. Remember, was 79,000, downgrade to 72, a drop of 7,000. This is brutal, right? August was 22, revised down to -4. There's your first negative on a jobs report, down 26,000. That is below zero. August is below zero. Now, the establishment survey did say, hey, you got 119,000 jobs in September. That must be nice. 97,000 were private, 22,000 were government, and at the federal level, you had lost 3,000. So an increase at the state and municipal levels. 97,000, but let's take out the non-productive jobs, healthcare, which is maintenance CapEx. So growth CapEx, really, 40,000 is what the economy created. And every month this year has had revisions to the negative because the sample size is small. Your standard error is really wide. This is within the 95% confidence interval, by the way. It has to be greater than 136,000 to be significant. It's 40. This is statistically not significant. Said in more academic terms, if this is what you came up with in your paper after collecting your data, you would have to say, my results are statistically no different than zero. No effect here. Average weekly hours were unchanged. Average hourly earnings came in at 0.24. Annualize that. It's 2.99%. Well below what the Fed says is consistent with 2%. Interesting. Household population growth, 225, but labor force growth was 470. So if you create no jobs, the unemployment rate would increase even if no one lost their job simply because the labor force grew. Participation rate 62.4, that's up 0.1. Employed, here we have 119 from the establishment. You have 251 from household. However, it has to be greater than 600,000 to be significant. So that number is statistically no different than zero. Unemployment rate 4.4%, up 0.1. So you can always get the unemployment rate up. Not by separating people from their jobs, but bringing the labor force up. So if the labor force increased dramatically, you could get that unemployment rate pushing 5, 6, 7% if a whole bunch of people entered the labor force. How is this possible? 470 when the population only increased 225. Well, when people aging in. Remember, that counts 18 to 60, 64, 65. So more people aging in than leaving. Graduating in. If you weren't looking for a job because you're a student, you're not looking for a job. Now you're looking for a job, you've graduated into the workforce or stepping up. Look, a couple months ago I really wasn't interested, but now I am. So you could have a whole bunch of people just saying, hey, you know what, I am looking for work. Or I'm done school now and I am looking for work. Or hey, I couldn't before because I was too young. All of this is sort of signaling to me that the labor market is not showing any real growth. And I think on a forward-looking basis, we do have to look at the effect of AI. Now, I have heard over the weekend some commentary from some people saying, well, I use it and I don't see anything. Let me tell you, if you're listening to me and you say I'm using it and I'm not seeing anything, you're using it wrong. You have to take some time to learn how to ask it the right question, to put it in the right mood, let's say, by giving it a persona. If you're not getting value out of this, if you're not seeing it, you're just not using it right. Let's have a look at our economic calendar for next week. Monday, not much going on. Dallas Fed Manufacturing Index. And you have some T-bill issuance. Chicago Fed National Activity Index later in the day. Tuesday, look at this. You are going to get PPI. You're going to get retail sales before you get too excited for the month of September. But it'll still be interesting to see these numbers. If you are in ZQ or TLT, there's a risk event for you because we have been starved for pricing data for some time. Well, we are going to get September. Case-Shiller Home Price Index, business inventories, consumer confidence, pending home sales, and you get some regionals here, Richmond Fed, Dallas Fed. Do we have anything here? 5-year note auction. The 5-year, 2-year, that doesn't really matter. The 10 years a big one, the 30 years a big one for issuance. Going on Wednesday, durable goods. For September, we're still working through our backlog. We are going to finally get an initial jobless claims here. I shouldn't say finally, but we're back on track with initial jobless claims. I also think we had ADP in here somewhere. Let me go. There it is right here. ADP, Employment Change Weekly for jobs. I mean, really, we have that, and we do finally have initial claims. So where did we leave off? Continuing claims, the Chicago PMI. If you're into the energy sector, Wednesdays is oil inventories, gasoline inventories. Thursday is natural gas. We got a 7-year note auction. Here we got our mortgage rates, Baker Hughes. That really doesn't matter as much as it used to. We still have a whole bunch of data that is backlogged. We got to work our way through. There's Thursday, Friday, Canada. We got our GDP growth rate. We do have earnings this week as well, and we'll get to them when we talk about SPY. Last week I highlighted briefly that MicroStrategy's value had dropped below the net asset value of their Bitcoin holdings. And this week it seemed to be a bigger and bigger story every day. So let's revisit what we have, because I don't think that this is over. This at the top I have listed their debt, their bonds, the notional value 8.2 billion. There it is here, and they have preferred shares outstanding of 7.79 billion. He doesn't call them preferred shares, he calls them digital credit securities. Instead of saying we issued preferred shares, we have successfully issued digital credit securities. He is trying his best to save his company from a delisting if it is determined that he is nothing more than a fund. Well, you're not in an index of companies if you're a fund. So he is out there misinforming as much as he possibly can. Let's just look at their debt for a minute. 8.24. Some of it has a coupon attached to it, so I use the coupon with the notional to figure out the interest per year. 34.59 or 8.65 million per quarter. That is non-negotiable. That is an interest payment that has to be made. The preferred shares are non-cumulative and can be paid in either cash or shares, or not. It's up to him. So too bad for those preferred shareholders, but the Ponzi scheme is gone. I do describe it as a Ponzi scheme because I'll talk about that down here. Bitcoin par, the convertible in 2029. Bitcoin is below the par value of that one. and also for 2030, Bitcoin is below the par value for that one. So the value of the security backing the bond is lower. They are now under collateralized. I don't have the bond deeds, nor am I going to go through them to determine, is there some kind of step up that has to happen if the collateral value drops below the par price. Conversion price, we're at 171.76. Below the conversion price here, so you're going to have to pay that back. You got to come up with $1 billion for that. 672, you're way below the conversion price. You're going to need $3 billion for that one. This one here still is in the game. It's a small one, 800 million. This one is underwater. You'll have to pay that back. As we stand right now, this could all change, but as we stand right now, the only one is this 800 billion, so 7.4 billion is looming in the future that you have to pay back. So you're going to have to either issue more debt, more preferred, or more shares. Hard to do when you're selling at a 12% discount to your assets. 649,000 Bitcoin. This was the closing price, November 21st close, 56.1 billion. Market cap of 49 billion, 12.66% discount to Bitcoin net asset value. And this, by the way, is a 52-week low. IV still sort of hanging out at 88%, was 76, now 88, but Bitcoin went from 43 to 55. So the spread between the two has stayed fairly constant over the week. So one thing for MicroStrategy, it does still have a little bit more implied volatility than Bitcoin does, but I do expect those two to converge over time. Sorry about my chair, I'm trying not to move, but it is squeaking. Looking at their cash flow from operations, Q3 2025 and Q3 2024, I'm just looking quarter over quarter at their last quarter, they had negative cash flow from operations in both quarters. This is for the first 9 months of the year, negative cash flow. It wasn't just one quarter. So Q1 to Q3 of 2025, CFO is negative. Same with last year. CFO from investing has been negative because, of course, you're buying a lot of Bitcoin, which means cash flow from financing was doing all the heavy lifting. Because you got to come up with cash for this. If your operations are negative, you got to come up with cash somewhere. Well, that is issuance. All net cash is being provided by financing going forward. It's questionable whether there's any financing anymore going forward. In 2025, raised $2 billion in debt, $5.9 billion in preferred, and $11.9 billion in common. When you're trading at a premium to your net asset value, you can issue shares and buy more assets, and the asset value per share would increase. When you're below your net asset value and you issue shares and you buy assets, your asset value per share decreases. You make your shareholder poorer each and every time. Who's going to buy any more common shares? And as a company, why would you even issue shares unless you had zero choice? And if you did, you would begin to dilute all of those shareholders faster and faster. But when it's a matter of survival, that's probably what you're going to do. Debt, I wouldn't lend this company a penny. Would you? Preferred shares, you're not getting any return on those preferred shares. You'll get it in more shares. And remember, it's non-cumulative, so I can just cancel it at my whim, and that's it. Non-cumulative, and you get nothing. Thank you for your money, but you get nothing more. Who would do that? So I think it is very questionable whether there's going to be any positive inflow from financing. And if there isn't, then you're not going to get any outflows for investing to buy more Bitcoin. Where are you going to get the money to cover off the loss in cash from operations? You got to pay for that somehow. You're going to have to issue something. And your bondholders, when it comes time, are going to be eyeballing this unless you fix this problem. How do you fix that problem? So this company here, this is going to get, I think, a lot worse. Compounding that, you have bigger problems at the Bitcoin level. Your largest buyer is off the market. Your largest buyer is gone. the anticipated large buyer, the government, was still holding out some hope that they would buy 100 billion in Bitcoin. The head of the SEC ended that earlier this month, I think November 12th, somewhere around there, in some public statement, ended that altogether. So you don't have a sovereign buyer and you don't have a large corporate buyer, and the Bitcoin treasury model is under serious question right now, and your largest buyer is off the market, and I don't see them coming back. But without somebody buying some shares to drive the price up so that it is a premium again, this infinite money printing glitch is now an infinite value destroying glitch. This is a bigger deal than I think the market is thinking about. If you took a chart of Bitcoin, an intraday chart of Bitcoin on Thursday, and overlaid it with the S&P, or was it Wednesday? I think it was Wednesday. No, it was Thursday. It was Thursday. Step for step. It was move for move. So something happened in Bitcoin. That was the bigger cause of things. There was some concern, oh, we're in an AI bubble, everyone's selling, oh, it's NVDA, and then suddenly stories came out about, oh, NVIDIA's receivables, oh, it's inventory. I'm going to show you that, nope, it had nothing to do with that. That if we look at their inventories and their receivables and you normalize it by dividing it by its revenues, nothing to see here. So I would watch this week. This, I think, will be a bigger story because Bitcoin has found its way into ETFs. And these ETFs have found its way into a lot of holdings in different portfolios, in 401ks. And financial advisors over the last few years have been conditioned to say, well, you should hold about maybe 2 or 3% of your assets in crypto. And this will take down the whole crypto complex. So you have the crypto centric companies and issuers, which will drop. You have the ones that are guilty by association, the Bitcoin miners turned high performance computing will drop if you're holding any Bitcoin or in the Bitcoin complex. And even if you stood near somebody who liked Bitcoin at one time, hey, weren't you engaged in this a couple of years ago? I remember a post on Twitter where you were all in support there, all going down as well. Okay, let's do a small tour of NVIDIA first. This is a sort of a messy spreadsheet I was just working on just to do some quick calculations for NVIDIA. And what I've done is I took their quarters, Q3 26, Q2, Q1, Q4 25, Q3, Q2, Q1, and Q4 24. There's the revenue. Quarter over quarter follow at 22 to 26 to 30 to 35 to 39 to 44 to 46 to 57. That's an acceleration. If you look at the growth rate over all of these, 17% growth quarter over quarter, 15%, followed by 16, followed by 12, followed by 12, followed by 6. This is where you would get concerned. Oh my God, growth is dropping, followed by 22. Incredible. Accounts receivable and inventory went from 10 billion for Q4 2024 to 33 billion. That's an increase of about 300%. And inventory from 5.2 to 20 billion. People saying, oh, it's their receivables, they're not collecting. Oh, it's their inventory. You can't look at that. If your revenues are going up and you're a growing business, your working capital accounts will increase with it. Period. You have to divide it by revenues. And so I do down here, accounts receivable divided by revenue, inventory divided by revenue. We had 14 accounts receivable with revenue, 14.64, 14.87, 12.56, 14.66. How come nobody was yelling about it here? Nobody was yelling about it here. Nobody was yelling about it here. Suddenly, oh, they're not collecting their receivables. No, this is normal. It's well within the range. Inventory to revenue. 7.61, 6.56, 6, 5.72, 4.87. Well, what would we expect from a company that is growing? Their working capital accounts would grow as well. On a nominal dollar basis, you may point out, but the percentage of revenue, look at it, it is increasing. If you have more products, more product lines, and the complexity of your products is increasing, you will have more SKUs, you will have to hold more inventory as a percentage of revenue. You sell one thing and only one thing, and demand is 100% for it, then you won't have inventory growing with revenue. Not to this extent. But the more SKUs you carry, the more product you carry, the more markets you try to reach, the more you're going to have to carry. This is 7.61. This is not to the point where you'd say, oh my God. Now, if you saw quarter over quarter that it held 6, 7%, and then suddenly you saw 10, then 12, then 18, that's the problem. That's a big one. This 100 basis point increase here and there, that is not a big deal. So no, chasing their inventory numbers around, chasing their accounts receivable around when their free cash flow is $22 billion. You're missing the point. Q3 2025 EPS $1.30. The price $178.88. So I figured out what their forward multiple is based under a number of scenarios. Let's assume 0% growth all the way to 50% growth. Look at the year-over-year numbers. This is year for the quarter, Q4 25 over Q4 24, 80% growth, 70% growth, 55% growth, 62% growth. And I'm saying let's assume 0% growth. You're at a 34.4 times forward multiple. Clearly, that cannot be right that there's zero. What do you want to do? Give them 20? That would put their forward earnings at 624, 28.67 times forward earnings. Let's keep in mind the SPX is sitting at around 22 and a quarter forward earnings. This would put it at 28.67, and growth in earnings for the index as a whole is about 12%, sitting at about 22 and a quarter. 20%. You'd expect it to have a higher multiple. Let's put 30%, which is half. Let's say they are reaching a level where they're going to plateau and their growth goes in half. 26.46 at 40%, 24.57 at 50% growth, which is still lower than the growth that they're showing. That would put it at the same multiple as the S&P. Does that make sense to you? That a company that's growing at 50% should trade at the same forward multiple as the index that's growing earnings at 12%. So I suggest that this seems to be the more likely case. The average of these two is 25.52, so 30 to 40%, 35%. If we were going to say that growth is going to moderate, I'd say maybe that's the more likely thing. Certainly not going to drop to 20% or 0%, not from everything that I've been reading of the adjacent companies that are doing business adjacently to all of this stuff. Another thing that I saw is, their share count is increasing. This is odd. They claim to be buying back shares, yet their share count is increasing. So I went to check January 26, 2025, 24.477 billion shares outstanding. October 26th, 24.305. 172 million shares lower. If you look at their buybacks and how much they bought back, you look at that, you look at these, you say, well, that's consistent. I see no problem there, so no. They're not having a problem collecting their receivables. In fact, it's right in line as it should be. They're not having problems with inventory. They're just holding more items. They're just going after more markets. They don't have a problem with lying about their share count. Their share count is lower. So I don't know what number that other person was looking at. If you're going to focus on anything, it would be this over here. 4 customers. Customer A, 22%. Customer B, 15%. Customer C, 13%. Customer D, 11%. Somewhere 50, over 50, well over 50%, 60% of the revenue coming from 4. If they pull back their CapEx by 20%. That's a big deal. That ends up being a big deal. So if you are forecasting out NVIDIA's earnings, you're really looking at the CapEx of the hyperscalers because they are all NVIDIA customers. Let's have a look at their investor presentation. All right, this is on their website, so I'm not going to go through it in detail. They do go through this on the call. I do encourage you to head over there and look at some of the data and resources that they have. Revenue, Q3 of last year, 35 billion to 57 billion. That's incredible. Sequential revenue growth of 10 billion in terms of growth. That's quarter over quarter. 3 platform shifts, accelerated computing, powerful AI models and agentic applications on the path to 3 to 4 trillion in annual AI infrastructure build. Visibility into 0.5 trillion or 500 billion of Blackwell and Rubin revenue from the start of this year through the end of calendar year 2026. 500 billion. NVIDIA now the world's largest networking business. Data center in terms of compute, in terms of networking, 27 billion to 43 billion in 1 year. Networking, 3 billion to 8.2 billion in 1 year. Largest networking business in the world. Gross margins, yes, they are coming down, 74.6 to 73.4. Non-GAAP, 75 to 73.6. They are guiding to 75. We'll look at their guidance here shortly. Operating expenses are up. GAAP to 5.8, non-GAAP to 4.2. I think they're guiding to 5 billion non-GAAP. EPS, 78 cents to $1.30. Non-GAAP, 81 to $1.30. GAAP and non-GAAP the same. Summary of cash flow. Free cash flow, 16.8 to 22.1. That's in a quarter. They do have debt. They can pay off their debt easily, all of it, easily, with far less than 1 quarter of cash flow. I want you to think about that. This, you know, you can create earnings with accounting, but cash either shows up or it doesn't. It's closer to economic reality, and free cash flow in a quarter of 22 billion. Capital return, 11.2 billion last year, 12.7 billion this year. You can't see that little sliver at the bottom, but those are dividends. Largest component, share repurchases, and yes, their share count has dropped. We don't need to go through that. GAAP, non-GAAP. Here's their outlook. Revenue, 65 billion from 57 billion. 65 billion for Q4, plus or minus 2%. Gross margin, 75%. Operating expenses, 5 billion. Other income and expenses, 500 million. Tax rate, 17%. This does not look like a company that is saying, you know what, we think this is over. Or it does not look like a company that's saying, you know what, I think all the CapEx is over. One of the things, and if you saw my post on LinkedIn, this is what I'm going to repeat here. One of the things that we're not incorporating when we look at revenue, saying, look, the revenue just doesn't exist today. That's because the revenue streams just are not here today. In Gemini, what I'm seeing is after Gemini gives me some output, it gives me a link to a YouTube video that is very close to what I'm looking for to drive me to YouTube. And what does that video have? Well, I don't see it because I don't see ads, but I guarantee you that video has ads. So you can smuggle ads in slowly through something like that. Well, I pay the highest tier possible, so do not show me ads. So I'm not going to see ads showing up. So I don't know if they are or aren't, but somebody sent me a posting saying ads are showing up. Advertising, with the sheer number of eyeballs that this has, advertising, I think we're discounting that altogether. All the revenue tails that are coming in. Number one, this stuff is massively underpriced. You pay $20 a month for what you get, that's going to go higher. You're using the free version, that's going to get constrained even more. It's going to use older models and ads. So the amount of revenue in the future is going to be significantly higher than what we've seen. Also, let's look at consumer adoption or user adoption. No technology in history has had a faster adoption rate than AI. So a technology that has the fastest adoption rate ever would naturally be accompanied by the fastest infrastructure build ever. This is all consistent. So I would take any opportunity of AI fears and a pullback to buy into this sector. Is it going to top out at some point? Yes, it will. Will NVIDIA go the way of Cisco at some point? Yes, it will. But not today. And I don't think tomorrow. I don't think 2026 either. At some point, you will hit some plateau. At some point, these models aren't going to get better, and the focus will then be on efficiencies and revenues. CapEx will slow down, but that's when revenues will really start to expand. So this, I think most companies are expecting this to begin to turn cash flow positive and profitable 28, 29. Until then, this is big. This is bigger than most people, I think, truly understand. And if you're saying, I don't get it, you're not using this right. I use it and it's killer. So as far as these jitters this past week, as all of these names were dropping, I took the opportunity to say, I'll take this. I sold 170 puts on NVIDIA without hesitation. If it continues to drop more, I think I'll take it. I'll take it. Moving on now to SPY, down 4% from its all-time high, October 29th. Haven't had an all-time high since then. IWM down 5.9, IJR 8.8, and triple Qs down 7.2, 2.8% away on a closing basis, and it matters on the closing basis. On a closing basis, 2.8% away from a correction. SPY is 6% away from that. Forward operating earnings 296.15. Closing SPX 6602 gives us a multiple that's pulled back from 23 down to 22.3. It was 22.75 last week, and we still have elevated IV. Our last reading on that was 18.8%. We have some companies reporting this week, depending on who you like to listen to, 11, 12, 11, 12. Some notables: Tuesday, Best Buy, Hewlett-Packard, Dell, Workday, and Wednesday we have Deere. The economic calendar is light. Really, as we saw earlier, we have PPI, which is the big risk event. These aren't really big risk event earnings. Maybe Deere might have something to say, but overall, I don't know that they'll dictate the direction. I think our direction will be dictated by two big narratives. Last Thursday, we opened up strong and it looked good, and then it all disappeared. So the AI narrative was dominant. Oh, it's AI fatigue. Oh, how long can this continue? The revenues aren't there. It'll take 100 years to make money. Oh, they're extending their... All of that was going on. And I was watching both Bitcoin and S&P, the chart, one on top of the other, and they were moving in lockstep. I had a live on Thursday night, and I said, just overlay the two charts together and look at what happened during the day. The day was dominated by movements in Bitcoin. By the end of the day, it was frustrating listening to the narrative of AI caused this. Everybody changed their mind. Inventories are building, this and that. So I spent Thursday night doing that spreadsheet saying, this is not the case. This doesn't make any sense. I'm not seeing what you guys are seeing. I was able to refute all the claims. Oh, the share count is wrong. They're lying. They must be issuing shares. No, the inventory. Look at the inventory. No, it's the receivables. None of that worked out. By the next day, the narrative started shifting towards, well, maybe it was Bitcoin. Maybe something was going on there. And then the market separated midday. That the market began to rally while Bitcoin stayed under pressure, and the market was able to compartmentalize the two and say, no, everything is fine here. It is Bitcoin. And by the end of Friday, the narrative was, oh, well, it's Bitcoin, and I don't think that's over. So let's keep our eye on that. If there is any more narrative on the AI fatigue trade, I will step in and buy, because I don't think that is anywhere near over. If there is weakness next week, it's probably going to come from the crypto space. It would surprise me it wouldn't have any spillover, simply because of all the places that it's being held. So we are eyeballing that. 85 is a critical number. It has to get much above 85. A close above 90 for a couple of days would probably really give a boost to the market, because I think there'd be less pressure on selling what you have to sell. Close below 80, yeah, things could get pretty ugly. Before we begin, I do have a PDF up on the applied level, Understanding Stablecoin. It is in the financial sector. Our spotlight company this week, CRCL, a stablecoin issuer, had an IPO June 5th. IPO price was 31, settled more than twice that level higher. I think it settled in the low 70s on its first day. Went on pretty much in a straight line to an all-time high, June 23rd of 270. Has never reclaimed that. And on November 20th, hit an all-time low on a closing basis of 66.93. Finished the next day at 71.97. I think that CRCL was being thrown out with the larger crypto market, and it's important to understand that stablecoin is not crypto. I'll expand on that as we go through this. Implied volatility, 85.1%. That is elevated. It's not high enough to be a great vol play. There you want IV of 120, 130%. The higher the IV, the better. This is 85%, so the door on playing the volatility with a good exit is quickly closing. Market cap of 16.8 billion, total shareholder equity of 3.023 billion. This is going to become important a little later when we talk about the possibility of a capital requirement, a certain percentage of capital needed for the amount of stablecoin that you have. This gives it a price to book of 5.5 times, a price to sales of 6 times. Our discussion will begin with the Genius Act. We do have to understand what this is and what it offers. And not only what it offers, this is a double-edged sword. What it gives, it can also take away. And CRCL has opted to be regulated under the Genius Act, whereas Tether is not. I'm going to make the argument as we go through that CRCL may have to leave the Genius Act if it even wants to survive. So, Washington loves acronyms, guiding and establishing national innovation for U.S. Stablecoins Act. There's your genius. This was given to us July 2025. Places stablecoins outside the law. Little word, big meaning here. If you're outside of securities law, if issued by permitted users, and it has a definition of what a permitted user would be. This opens the door for banks, or at least subsidiaries of banks, and if stablecoin architecture and functionality prove to be very, very useful and the market grows, that is probably most likely what is going to happen, which is an existential problem for CRCL. Bank regulation versus SEC regulation comes with reserve requirements and restrictions. The reserves must be backed by U.S. Treasuries. That is both a gift if you have high interest rates and a curse if you have low interest rates. You have that sword of Damocles hanging over your head the whole time. Highly concentrated, 2 issuers own about 90% of the market. USDT, which is Tether, and USDC, which is CRCL, Tether being the big one. And this is as of November 2025. Tether, about 182 billion in value. Since each stablecoin is $1, you can say it's about 182 billion in circulation. CRCL, 75 billion. I've rounded it up. It's like 73.6, but they have a certain amount held by the company itself, which brings it to 74 and change. And then I just extrapolated to, let's say, the end of November and said, okay, well, 75, 182, 60% share. The reason I do that just makes the math and calculations I'm doing easier on the other way. So yes, I'm aware it's like 73.6. 60% share for Tether, 27% share for Circle, or 29% depending on what source you look at. Non-public, they are private and they are non-compliant with the Genius Act, whereas Circle is compliant and public. So they are the same coin, opposite sides. And this is the goal of a stable coin, is to maintain a fixed exchange rate. And this is done by holding a reference asset, which is usually a US Treasury, and from that issuing an equal dollar value of digital tokens, which is the stable coin, without the backing of a central bank or government. Now, this is done. The crypto community at large likes to say, listen, you can do all of this without the need for a trusted third party. The idea of the trusted third party was that, what if you did not have one? How would you conduct a transaction? It wasn't motivated by, oh my God, we can't trust any of our trusted third parties. We have to find a way to eliminate the trusted third party. I don't think anybody wants their trusted third party gone. It's just, what if one did not exist? That is the whole idea behind the blockchain and cryptos, at least the legitimate ones. But what if a central bank did issue one? What if a government did issue one? Now you have a trusted third party. I would argue that if you have the trusted third party, you don't need to find an elegant solution for what if you don't, because you do. Tether and Circle hold about 3% of outstanding T-bills. We're going to see that depending on where the interest rate is, if you have a whole bunch of stablecoin issuers governed by the Genius Act and they end up holding 20, 30% of T-bills, and the government decides, or the Federal Reserve decides, that for the sake of the economy, we've got to go to the zero line, these companies are all dead in the water. Revenue stops, which means all of those T-bills would hit the market. And that can be very destabilizing. So sort of a good situation on the way up, bad situation on the way down that the government has got itself into with this. Let's look at the models of stablecoin backing. There are three, and two really. One has sort of been discredited with Terra and Luna, but there are two big ones. The dominant model is fiat backed, where the issuer is going to hold US Treasuries. It can even hold cash. It doesn't have to hold US Treasuries. The Genius Act lays out exactly what it can hold. Holds Treasuries equal to or exceeding the value of stablecoin in circulation. The idea behind the holding, it's a reserve that you have to hold against every stablecoin issued, is that's your source of revenue. The largest part of your revenue for Circle, it's 96% of the revenue. So you want to get the highest yielding assets you can, which is a 90-day T-bill. Genius Act lays out what can be held to back a stable coin if you choose to be governed or regulated by the Genius Act. U.S. coins and currency, demand deposits at insured depositories. Circle has some of this for liquidity purposes. T-bills less than 90 days, repos backed by short-term treasuries, government money market funds, which is the majority of where Circle keeps its money, and central bank reserves. That seems odd, central bank reserves. The Genius Act does allow subsidiaries of depository-taking institutions to issue their own stablecoin. That is a threat to a company like Circle if this is really successful. If there is a big market out there for payment, especially cross-border payment, if the banks see that this is a really big market, they let these small companies prove the market first, and since they can do it, they will do it. And you know what you have? A trusted third party. The Act prohibits permitted issuers from paying interest to stablecoin holders, and there are some stablecoins out there that do pay interest, but they are securities. They do not fall under the Genius Act. Arbitrage maintains the peg. So you think, well, okay, you have treasuries and you have a stablecoin, but the market, what's forcing the market to say it's worth $1? What if we all get concerned about government debt and it trades at 80 cents? If USDC is trading below $1, you can buy the token and you can redeem it and get $1 back. If it's trading above $1, you can deposit $1 with Circle. You get a coin and then you can go ahead and sell it. This redemption creation process comes with fees and minimum sizes. So like an ETF, there are authorized participants that then arb this to $1. For Circle, reserves are predominantly holdings in the Circle Reserve Fund. This is a government money market fund, SEC registered and managed by BlackRock. So you're going to have management fees. Just to start laying out some of the expenses they have their reserve income, and against that income, that's the gross, they have fees, and you're going to have custody fees as well. So they don't manage it internally, which would come with a cost. They have it managed externally. But at some point, if this is successful and the size of that fund grows and grows and grows, they might internalize it. If they decide that if the Fed is too aggressive on moving rates closer to the zero line, their revenue dries up, their best course of action would be to leave the Genius Fund and be able to invest that money in other assets. Let's have a look at Tether. 81.5% in treasuries, 5.1% in Bitcoin. They also hold secured loans, corporate bonds, and precious metals. They publish quarterly reports, but they've never undergone a full public audit of its reserves. Whereas Circle, the reserves are verified by a Big Four accounting firm, and they have monthly attestations of where their reserves are, what the reserves are held by, and verified. So they have their money in Circle Reserve. They do have money in cash as well. Cash has no performance. So you got to keep cash for liquidity. If you're forecasting out liquidity, you expect it to increase, you're going to have to move more to cash, and there's a hit to your revenues. The second model, a smaller part of the market, about 18% of stablecoin value, is crypto collateralized, which employs over-collateralization, which is an extremely inefficient use of capital. I make that point here. So a good example is MakerDAO's DAI, 150% collateralized. Inefficient versus fiat-backed, but operates entirely on-chain with smart contract enforcement. I want you to think about that for a minute, because my answer to that, when I came across that, I looked at that and said, okay, well, that's the feature. And when you do a PhD, you're always trained whenever you come across new information to ask, so what? Okay, you wrote this great paper, that's your conclusion. So what? So if I have a stable coin, the choice is between two, and you say, well, this one's backed by US Treasuries, this one's backed by crypto, but it operates entirely on chain. What would you say? I think most of us would say, so what? There it is. It operates entirely on chain for those of you that really care about that with smart contract enforcement. Looking at a crypto collateralized stablecoin that also pays interest, Athena USDE, about 6.2 billion, maintains crypto reserves that are crypto hedged with short positions with perpetual futures. And you know, based on a futures curve, the more in contango it is, the short position gets the carry. So if you have the underlying and you have a short futures, you are earning that carry. So it captures the funding rate, about 9 to 15% yield, and it distributes that to holders. Well, distributes some of that to holders. Obviously, outside the act, they've chosen to hold crypto as their reserve and not US Treasuries. Combine that with the futures to make it risk less, capture the funding rate, and pay an interest on it. That is a security. Algorithmic stable coins, this is mostly dead. The Terra Luna is a good example. If Terra was trading for less than $1, you would burn a Terra and mint $1 of Luna. So fewer Terra would force the price back up. More Luna would force the price down. If Terra was greater than $1, you burn $1 of Luna and mint 1 Terra. This collapsed in May of 2022. So we really are left with fiat-backed or crypto-collateralized. And fiat-backed, if you're within the Act, is all treasuries. If you decide, well, I don't want to be in the Act, but I don't want to be crypto-collateralized, you can then run it like you would run a hedged return-seeking portfolio. So in immunization for insurance companies that have liabilities, long-tail liabilities, they need to hold assets to meet those future liabilities, but they need a growth rate. So they will hedge a significant portion of their liabilities, but they'll also have a smaller portfolio, much like Tether does, 80% hedge, 20% return-seeking, where in that return-seeking portfolio you can reach for higher yield, and the 80% really provides a lot of safety and a lot of liquidity that is needed. So you can do that, but you would be leaving the Genius Act at that point. Let's have a look at who the permitted users are under the Genius Act. Number 1, subsidiaries of insured depository institutions that have been approved to issue stablecoin. There's your banks. Number 2, federal qualified non-bank issuer approved by the Office of the Controller of the Currency. There's where Circle sits. And number 3, state qualified issuers under state regulatory regimes. Once the stablecoin in circulation is over 10 billion, they are subject to federal supervision. And as an issuer, you have to maintain some liquidity. So you have to strike a balance between meeting redemptions while avoiding overly conservative standards, because the reserve income is your revenue. Responsible for risk management, regular reporting, and attestation requirements. This is monthly and examined by a regular public accounting firm, plus regular audits if greater than 50 billion. There sits Circle. Okay, with that behind us, let's start to understand Circle's income statement, and we'll look at its revenue and its cost of revenues. The reserve income, that is their dominant revenue source. So I'm going to just give you some rough numbers here. 75 billion in circulation at 3.88. That's the effective federal funds rate. They're actually 73.4, 73.6, and they can probably get 4% if they were all in 90-day T-bills, for now. Their revenue is not dictated by the skill of management. To some degree, part of their revenue is, if you think about it as a square, revenue, length times width, quantity times price. The quantity is a function of management. Price is set by the government. Ouch. And price is set by the government to achieve ends that do not concern Circle in terms of the discussion at the Federal Reserve. So if you had that, 75 billion at 3.88 is 2.91 billion. That's assuming no cash reserves. Q3 2025, 711 million of their revenue. Here it is down here at the bottom. 711 million was from reserve income. So if you multiply that by 4, you get to 2.844 billion versus 2.91. You can see how close that is. That's 96% of revenues is dictated by the decisions of the Federal Reserve. Sensitivity of 100 basis points is $750 million. That is 25% of their revenue. That's a whole quarter gone with a 100 basis point decrease in rates. And that's assuming that circulation doesn't increase. On their current circulation, that it doesn't increase. I think we're going to get minimum 100 basis points over the next year. So Circle is facing 25% of its revenue disappearing unless it can grow its token. So if you cut interest rates in half and you're able to double the token value, I personally think you're looking at 200 basis points of cuts by the end of 2026, which means to keep the revenues constant, Circle will have to get circulation from 75 billion to 150 billion over the next 12 months by the end of next year to be a no-growth company. That would be no growth in revenues if they can double the stablecoin in circulation as the central bank takes away their revenue. You see, the problem with the Genius Act is that your price is completely dictated by something you have zero control over. Now, I want you to imagine if a liquidity crisis happened and the Fed had to go to the zero line. There is no increase in stablecoin circulation you could achieve to make up for that. You are dead. Your revenue, because it's 96% of your revenue, dries up. So you have to think about your other revenue category, which is transaction revenue and minting and redemption fees. Minting and redemption is about 0.1 to 0.3, so we're not getting a lot of help there. You have transaction revenue. So in the category other income, it's about 4% of revenue. That is simply just too small right now, and their running costs are about $800 million a year. So this is a big deal. If you're going to forecast these top line items, you have two things. You have to forecast the token growth, which comes with its own issues as well. Is it going to be something big, or have we seen the initial adopters adopt it and say, "Nah, okay, this is pretty good," but that it isn't going to cross that chasm for mass adoption? Or is that pending? And if it is, I argue you're going to have the same model you had in the 90s with internet service providers. The telcos watched all the small companies prove the market first, and then they just did it themselves and wiped them out. So if you have all these stablecoin issuers proving the market, and it really is successful and it gets big enough, remember, a subsidiary of a bank can do this. They're going to do it themselves. Whether it is token growth, if it's very successful, I think they're out of business. Or the path of the 3-month rate, if it goes to zero, I think they're out of business. There is just huge risk in both the quantity and the price of that revenue square. Expenses. This is interesting here. Circle gets to keep 100% of its expenses, but only gets to keep 37% of its revenue. Distribution costs. These are arrangements with platforms and partners. And Coinbase is Circle's big partner here. Circle pays Coin 50% of the reserve revenue generated from USDC held on the Coinbase platform, and 100% of the reserve revenue if the issuer held USDC in Coinbase branded products like Coinbase Earn. And the CEO of Coinbase is very eager to make Circle the largest distributed stablecoin in the world on their platform. Look at their distribution costs down here. Distribution transaction costs. Of the 711 from reserve revenue, they got to give 447,000 over to Coinbase. Coinbase gets 63% of Circle's revenue and 0% of their expenses. What a sweet deal, right? So even if we go to the zero line, Circle has 0 of the expenses and would still take 63% of whatever pennies they got. If you look at the 9 months ended, fairly stable. Reserve income, 96%, 96.3% of total revenue, and your total distribution transaction costs, 63% here, 62.9% here. So there's the third thing that you have to forecast if you're trying to get to gross profit or gross income. Not only just the growth in the stable coin, not only the path of the 3-month rate, but how successful can Circle be in bringing the USDC off the Coinbase platform onto other platforms where it doesn't have to share that revenue, where it can keep 100%. Let's go below gross profit. Let's look at some operating expenses, running infrastructure, technology development and maintenance, compliance and legal, reserve management and custody fees, attestation and audit fees, and personnel and general corporate expenses. The Q3 was about $211 million for that. Profitability depends heavily on interest rates remaining elevated. If rates return to the 0.2, even on $200 billion, we're going from $75 billion, and I'll give them $200 billion. They are one crisis away from this, by the way. You get another crisis. You get private credit and crypto crashing and destroying a lot of liquidity across the globe, you're going to the zero line. And even if they could get from 75 to 200, that would be 400 million in revenue. But remember, they only keep 37 cents of every dollar because of their agreement with Coinbase. That'd give them 148 million against about a running cost of 800 million in OPEX. You can see how this equity over here at 3 billion would start to disappear very quickly. If there is more competition, let's say another startup decides, hey, you know what, we'll join the Genius Act as well. Well, that would increase distribution expense because that company would have to say, well, we can only make as much reserve revenue as we have stablecoin in circulation. We need distribution. Well, you got to pay people. You got to pay other companies. Because I have this big platform, I'm going to say, well, what you going to give me for distributing your token, buddy boy? Which would then just drive up distribution costs for everyone. Capital requirements also pending. The thought is maybe there'll be a 2% capital requirement. On 75 billion, that means Circle would have to hold 1.5 billion. They have capital. If we look at their stockholder equity of 3 billion now, no debt. So all of their capital is equity. So if rates did fall 200 basis points, and if circulation did double to 150 billion, you would say, well, that's a zero growth company. The growth in the coin compensated for the drop in the rate. But at 2% capital requirement on 150, you are right at your limit, which means any slippage at all, you got to issue shares. Well, we'll put an E for equity, or you have to issue debt to raise your capital requirement. So the larger it grows over here, the more capital it's going to need over here, the more important it is to have retained earnings to keep increasing this capital so that you don't have to issue debt or you don't have to issue equity. But I tell you right now, the Federal Reserve is going to be cutting rates over the next year. Coinbase's revenue in terms of price is going down. They must get circulation up, but in getting circulation up, you need more of this stuff. Unless you leave the Genius Act. Competitor Tether, not in the Genius Act. First major stablecoin to achieve scale. There are issues of reserve transparency since they have no public audit, but they have always maintained the peg and where they operate, and air quotes here, the type of people that use it would rather not have a lot of eyeballs looking at them. They dominate in Asian markets, Latin America and Eastern Europe, where their customer base is less concerned about attestation quality. 18th largest holder of U.S. debt, though. So if you're going after the retail crowd, there you are. If you're going after the institutional crowd, yes, your reserve transparency really matters. Circle has decided we want the institutional crowd. So they are at the will of the Federal Reserve for the major part of its revenue, whereas Tether says, you know what, we'll go after the retail side and we don't have to worry about that. And it can hold a hedged return-seeking portfolio, 80%, 81% in treasuries, the other free to earn a return. So let's compare these two together. They're the two big ones, 90% of the market, USDT versus USDC. Circle also has a euro coin, but it is immaterial. It is small, so we're not going to discuss it. Tether, superior liquidity across more trading pairs, deeper order book on exchanges, broader geographic distribution, strong presence in emerging markets, deployed on numerous blockchains. 45% is on Tron. Circle, superior transparency, clearer regulatory status, more conservative reserve composition, stronger alignment with institutional compliance requirements, deployed on 28 blockchains. Coin CEO stated their stretch goal is to make USDC the #1 stablecoin globally. So this is a benefit. You're paying Coinbase, but Coinbase is motivated to make your coin really successful. The #1 stablecoin globally. Well, they're saying it and then there's actually getting it done. There are big network effects here. So the winner usually stays the winner. These are winner-take-most markets. Others, Ethereum, USDE, we saw that earlier, about 6.2 billion. PayPal has PYUSD, about 2.4 billion, small compared with Tether and Circle. JP Morgan has JPM Coin, private permissioned system, wholesale payment settlement among institutional clients. And yes, as I said, there are network effects. A stablecoin becomes more valuable when more merchants accept it. This is if you're using it for transactions, as opposed to just payments or settlements, but actual transactions. More exchanges list it in trading pairs. So Bitcoin versus USDC versus Bitcoin versus US dollar. If you are quoting this and trading this does require a banking relationship. More decentralized protocols integrate it. More blockchains have it. More wallets support it, and more holders use it for transactions, which goes in line with more merchants accept it. Because there are network effects, because of all this, this suggests an eventual oligopoly. Large financial institutions, these being the big banks, already have a lot of the infrastructure in place for stablecoin, not the technical infrastructure, but all of the administrative infrastructure. They have compliance, they have anti-money laundering programs, regulatory reporting systems, and operating infrastructure. And this is sort of the two-sided trap that Circle has. Let's say we'll put not successful and successful in their circle. Let's say that they're successful and stablecoin really grows. The banking system's not going to sit back and say, well, it's okay if our deposits leave, our cheap money leaves. It's okay if that leaves the system and heads over there. No, they're going to do it themselves. Just like the 90s, the telcos just watched all the small companies say, okay, you guys just keep going. We'll sell you our capacity, but if you're really successful, well, you know, we're just going to do it ourselves. So there is an existential problem with success. If you are not successful, well, rates are coming down. If you can't grow that stable coin, there goes your revenue. There's an existential threat. The best course of action for Circle is that rates stay fall and maybe hug around the 3%, and it is moderately successful, but that the banks decide that the technology implementation is something they don't want to do. It is moderately successful, which puts it at probably a low growth company, so that its valuation at these levels is still too high. That's probably their best route out, or just leave the Genius Act. Then you begin to evaluate these companies as fund managers, and not necessarily as technology companies, but fund managers with a huge technology expense. So I think it's clear by now, stablecoin is not crypto. Stablecoin is for payments and settlement. It is financial infrastructure, whereas crypto is for speculation and investment. And if I had my way about it, I would just erase that one word. Let's get to know Circle a little bit more intimately here. Its coin, USDC, was launched in 2018 in partnership with Coinbase. It attempted a public showing, listed through a SPAC. Look at my spelling. Let's put an H on the end of that. Listed through a SPAC in 2021. This fell apart in late 2022. They IPO'd in June of 2025, raised $583 million at $31 a share. First day of trading closed in the low 70s. So in hindsight, they could have listed at 62 and raised 1.15 billion instead. This liquidity event triggered share-based compensation in Q2 of 423 million. So if you look at their Q2 statements, they lost money primarily because of this trigger that they did not have in Q3. Let's look at some numbers from Q3. 97% growth in USDC year over year. If you look at Q3 2024, 97% growth. They have 29% market share versus 25% 1 year ago. So if we look at 25 to 29 and take an average, you get to about 27%. Some sources list them at 27, which is the average. Or some sources list them at 29, which is what they reported as of September 30th. Wallets that are holding more than 10 USDC. They call these meaningful wallets. Up 77% to 6.3 million. Revenue growth 66% year over year. That's for Q3. When we say year over year, Q3, 68.6% if we look at Q1 to Q3 year over year. So just for the quarter, they're up 66% versus the quarter last year, or 68.6% versus the first 3 quarters of this year versus last year. Circle Payments Network positions Circle as infrastructure for institutional payment flows. Institutional payment flows. So reserve transparency is really important to them, and that's where Circle is headed. Into the mouth of the beast, I would say, because again, if they are wildly successful, I don't see how the banks would not just say, okay, thank you for that. We'll move in now. They did try to get a bank charter. That failed in June of 2025. Failed. It wasn't rejected. It just wasn't accepted. There was opposition. It would have been called the first National Digital Currency Board, providing custody services for digital assets, including potential tokenized securities and bonds, a way to increase that 4% other revenue. But it was not to be. It still remains under review. It is pending versus rejected. Relationships outside of Coinbase, Finastra, Visa, Kraken, they're attempting to generate alternative distribution venues rather than just on Coinbase, so that they don't have to share their revenue. Arc blockchain, something they're working on, an effort to build their own layer 1 blockchain, purpose-built for stablecoin finance. Very high throughput, low transaction costs, and native integration with USDC to combine blockchain programmability with stablecoin stability, for those of you where that matters. Blockchain programmability, automated payments, conditional settlement, programmatic treasury management. Okay, let's visit some valuation issues, and we'll look at a number of scenarios for revenue. Price to sales right now, 6x. Stablecoin market projection, 20 by 2030, 1.9 trillion. That's not really a pessimistic or really optimistic. It's sort of a middle of the road, 1.9 trillion by 2030. If they hold their market share at 29%, we start there. You might have a scenario where they increase their market share, but at 29%, let's see how they do. They'd grab 551 million in terms of stablecoin in circulation. Over the 75 now, over 5 years, is roughly about 49% growth per year in circulation without growing market share. Let's look at their top line revenue. Now remember, they only get to keep 37% of this unless they're also successful in moving off the Coinbase platform. So I have here by 2030, average 3-month rate 3%, 2%, 1%, and 0.2. And assuming 551 million, what their reserve revenue would be, 16.5 billion. But if you go to 2%, it drops to 11 billion. 1% drops to 5.5. 1.2 drops to 1.1. They, at this level here and higher, would have net income greater than 0, CFO greater than 0. That is including their transaction, their distribution fees as well. But below that, they would not. So if you're forecasting out to 2030, you're going to have to come up with some assumptions. Can they survive from now to 2030? Let's say something happens and you got to go to the 0 line to about 2029 before you start raising again. In 26, all of 27, all of 28 at 0 revenue, losing $650 million a year would wipe out 60%, roughly 60% of your capital. Would they even survive? Assumptions required: circulation growth. There is, we're going to calculate top line revenue. We need some assumption of circulation growth, which is going to be a combination of your market share times market size. Right, so if you think the market is going to grow at 20% a year and you're going to increase your market share by 200 basis points a year from 29% to 31% to 33%. That'll give you circulation growth. So 1, 2 assumptions build up to your third. Your reserve revenue, it would be whatever USDC value you have based on these two, times your 3-month rate. There is another assumption you need, times 90 to 95%. Why 90 to 95%? Because you do hold some in cash. You don't have 100% of your reserves in 90-day T-bills, because you will have creation and redemption going on all the time. You will have to meet redemptions. You're going to have some in cash, so 5% or 10% of whatever you have in circulation. And you also need an estimate for what the off-coin circulation is going to be, so that you can figure out what your distribution costs are. Big threats to this company: rates at 0% and bank competition. If the economy needs it, rates will go down, period, without any thought to coins revenue. It's not as if somebody from the White House will walk over to the Fed and say, hey, the Genius Act, that's our signature policy for these people. You can't lower rates to 0. You'll put this one company we have out of business. It's not going to matter. Bank competition. JP Morgan, Bank of America, Citigroup, all looking at this hugely, wildly successful product, growing at 49% a year. Reserves leaving their bank over to Circle to hold balances in stablecoin. Thank you for the success. Thank you for the demonstration, but we'll take it from here. In the end, Circle can just leave the Genius Act. If you get down to 1% and you're at 5.51 billion, you get to keep 37% of that. If you can keep your operating costs at about $1 billion, you're profitable, but that's really about it. If rates are going to stay at 1% for a period of time, all you can do is increase circulation of your coin and move away from Coinbase as much as you can. If you leave and you are governed more as a security, then you can hold what Tether does, which is a return-seeking portfolio. The growth in stablecoin has been impressive, and on the institutional side, the adoption has been impressive. It doesn't require me, for the institutional side, it doesn't require me to hold balance of stablecoin. It doesn't even require me to even be aware of stablecoin. I have my bank account in one country with USD. I have a bank account in another country with USD, and I'd like to transfer money. Well, this is financial infrastructure that does it. I issue an order on this side and it goes through that side, and well, it's not as quick as you'd like it to be. Although I can get it down to about 5 to 10 minutes. It really doesn't take very long, except if I issue something at 3 in the morning, I do have to wait until 9 in the morning before it goes out. It is pending until that time. But I don't really need to transfer money that quickly at 3 in the morning. But stablecoin operates in behind here. So it'll take the USD, it'll convert it to USDC, boom, it's over here, and then it'll convert back to USDC, so that I don't actually see the USDC, I don't actually hold any balances of it, it just happens in behind. Well, that's kind of neat. If it can happen really quick and lower my transaction costs, that's kind of neat. So I can see, because I do have cross-border payments that I have to make, I can see the value in it very quickly. But there are already a lot of money transfer systems that solve most of the problems that most people have. So in forecasting out the growth of this, you also have to say, well, what solutions already exist for people that are good enough? Within Canada, if I need to send money, I could use e-transfer. If it's below a certain amount, it happens right away. In the US, Zelle happens pretty much right away. I can transfer US dollars from US accounts in 3 different countries to other countries, and it happens in 5 or 10 minutes. And oftentimes free. Oftentimes there is no expense for me to get that done. So I look at this and I say, well, that's kind of neat, but it's not as if it's 100% of what I do. I'd say, well, there are occasions where this would probably be better than instead of going through things like PayPal or something. This would probably be better, but it is a small part of the problems I have. So if you're forecasting out circulation growth, that is the thing you have to think about is there really a big market in this problem? Now, you may have better insight than I do, but that is one of the assumptions that you would have to make. Overall, being that one part of my revenue, the price of my revenue, is determined by the economic viability of a country, where we have a president who is demanding, with the new Fed chair coming in, that you lower those rates. You basically have a president on one hand who's given me the Genius Act, and on the other hand says, wait till you see what I do to your revenue. I am going to eliminate it completely. And I am competing, in the end, with a president who does have interests in crypto ventures. So maybe I'm competition that he doesn't want to see. Either way, I'm not a buyer of this company. Well, that's the end of it. If you found this useful, I try to do one of these every week. If you look back over the last 5 or 6 weeks, we've highlighted one company every week. We're going to do 2 next week that are engaged in network connectivity. Really interesting stuff. So if you want to keep up with this, click on subscribe, and also smash that like button, because it does help with the YouTube algorithm. Also in the description box, I'll say it again, you can find a link to an email list. Leave your email name. On Fridays at 4, we email you the infographic for the company that we'll be looking at on Sunday. So if you're already on the list, you would have gotten your Circle infographic in your email Friday, and you would have been up to speed on what this company is. Next week, I'm highlighting 2 companies.